My name is Jeff Green, and I'm welcoming you to the 2018 July housing market update. I'm going to quick introduce our panel. Melissa, hopefully we're on panel view, so everybody can just wave when you hear your name is called here. We have a great panel, very excited to welcome everybody. Keren Gonen from Green Team New Jersey Realty. She's a sales associate in our Vernon, New Jersey office. Welcome, Keren. We also have Kevin Dolan from Panebianco Home Mortgage. Kevin is a branch manager and co-director of renovation and construction lending, something we're going to talk about in depth today. Kevin is also joined by Joe Panebianco from Panebianco Home Mortgage. He's the CEO. So we're very blessed and proud and excited to have these two gentlemen alongside us here this month to contribute to the discussion. And then, of course, last but not least is Melissa Brzett. She is our marketing director for the Green Team and the brains behind our whole production here, and will kind of guide us through technologically to make sure that we have a good meeting today. So thanks, everybody, for being here. What I'm going to do is I'm just going to jump in real quick to our presentation that we have set up for you. And we're going to share some housing market stats right off the bat. We're going to jump right into it. Okay, so these are high times in the real estate market. And, you know, it's interesting. I've got a little historical perspective for us today, both nationally and locally. And, you know, this is just fascinating to look at. You know, the gray bars are indicating recession times. And you can see that one thing that's interesting to me is that, you know, the recession, if you look here, the recession didn't necessarily trigger the downturn in the housing market. It's almost the inverse relationship, that almost consistently the housing market downturns have triggered the recessions, with the exception of the one between 2000 and 2005. So, you know, of course, in high times, you're always wondering, how long is this going to go? Is it going to sustain itself? So on and so forth. So it'll be interesting to see. One other thing that is interesting to take a look at is, you know, the duration of the downturn. You know, and that's one of the things we're going to look at in just a few minutes, raw numbers locally. Really, the downturn, everyone thinks about 2008 and the financial collapse, but the housing market really started to turn down right at the end of 2005 in terms of the number of units sold. Price peaked right at 2006, middle of 2006, and then it continued to slide for a decade. So the steepness of that curve and the duration of it is what's interesting over the course of time. Here's a look at Sussex County historical price index, so on and so forth. Just as you know, we were just looking at the Orange County, New York housing stats there. Going back here a little bit, let's look at some national numbers. You know, total home sales in thousands. You know, I'm not going to bore everybody with these. You're going to be able to take a look at these on the blog post that we post after the presentation and after our meeting here today. But again, just a look at where we were year over year, you know, pretty dead even. You know, we're not seeing major increases anymore year over year. We're about the same level as where we were last year. This is an interesting chart here, which shows us that we're way down. We're way down in terms of the lower price range and how many sales are happening versus the previous year. But we're also seeing an uptick in, you know, the higher end price, 1 million and up. We're seeing a big uptick on those. So that's interesting. I think what's happening is buyers are just simply being pushed into those higher brackets because there's just nothing left on the low end. Here's another graphic that shows that proportion as well. You know, the sheer number of distressed property sales that are taking place are, you know, way down since 2012, and that's a good thing. I don't see any problems with that one in particular. Here's a graphic that I like to look at consistently, is units sold. I think, you know, the number of homes being sold is the mother's milk of all analytics in the housing market, because no matter where pricing is, you can always get an idea of how many homes are actually being sold. And you can see that, you know, there's been great increase, year over year increase for the past 5 years, but now it's really slowed down. And you can see that some of the months, basically, it's been, a mixed bag year over year, 17 versus 18 in terms of increases. So we're seeing a flattening, basically, in units sold. It's Orange County units sold. Here is, again, the local stats. We're just looking at the New York side of the border today, just to be brief and keep things moving along. Homes that sold at 100% more of last asking price. This is interesting. There's been a little bit of a spike here. And we'll check in with Keren Gonen here in a minute, who's one of our sales associates in the Vernon office. It's a hot market. There's a lot of bidding wars. Any home that is well located in good condition is pretty much, having multiple offers at any one particular time. So that's interesting. I mean, this number basically states that almost half, of every listing that's on the market is being bid over asking. So that's interesting. And days on market continues to decline, which shows, again, a strong seller's market. So a lot of indications as to, we're in a seller's market, no doubt about that. This is a little bit of a treat for all of us. I actually did some digging and found numbers going all the way back to 2005. Now, these are not national numbers. This is just Orange County, New York, but it's still relevant because I can tell you I've been watching these numbers for almost 15 years now, very closely every month. And the trends follow one another. The national trends, when the national market's up, Orange County's up, so on and so forth. But I just find this to be very interesting. The peak of any market in Orange County, New York was 2005 in terms of the number of units sold. 2006 was the highest price Orange County has ever seen, average home price. 2005 was the peak in terms of the number of units sold. It was 5,028. Last year in 2017, we were above 2006 numbers. We were at 4,589, just below the peak of 2005. So this is legitimately a hot market. This is legitimately reaching peak numbers. Now, it'll be interesting to see, I think, from a couple slides before, we saw the mixed bag, the flattening of the curve. So I don't know that we're going to get to 5,000 transactions this year. And I don't necessarily see that as a bad thing. But that just gives you some historical perspective on where we were. But look at the slide, it was remarkable how 3 years later, it was half of the units sold. That's how precipitous the decline was. And I think that we're all hoping at this point that, when we do, because this too shall pass like everything else, when we do see a downturn in the market, we're just hoping that it's not as precipitous as what we saw the last go around. So a lot of talk about recession, when it's going to happen. There's a lot of articles, Wall Street Journal survey, this, that, the other thing. And everybody's, kind of talking about, all right, well, when is the next recession coming? Because we know in a capitalistic society, it inevitably is going to come. So here's just some more, expert opinions, statistics, so on and so forth, about price change, during the last 6 recessions. And you can see, this one was of historical proportions, 2008 to 2010. I mean, that was, I'm very hopeful that we're not going to see those times anytime soon. But needless to say, you can see that, prices really weren't affected all that much historically during the recession times. Now, again, if you go back to, I started here because I wanted to give you a historical perspective, but if you go back here, you can see that the recession periods as designated by the economists and the true definition of a recession doesn't include the whole downturn, right? So this slide back here is a little bit misleading because obviously our marketplace is a slow, much slower path to go down. So a lot of good information here, a lot of, interesting analytics and so on and so forth. So I'd like to bring in, before we get into talking about mortgage, interest rates, construction loans, and overall economy, Keren, let's open up your mic. Go ahead and unmute yourself. And, I'm getting the sense that it's still red hot, very hard to find inventory for buyers, really quick to sell homes for sellers. What are you sensing there, troops on the ground here?
I would definitely say that it still is a very hot market, both in the New York and the New Jersey side. I know in New York, if you don't jump on a house right away, and I would say 90% of the time we're in highest and best. And this goes pretty much across Orange County. I have a few in Ulster County, it's the same case, but in Orange County, whether it's Montgomery, Middletown, Warwick, we're in bidding wars on each and every house. And this is within days of the house going on listing. It's not something that's taking time, it's immediate.
Yeah, yeah, that's interesting. I mean, so there's definitely an inventory shortage. There's more buyers than there are homes to sell. That is a problem, and that's, ultimately driving price. And, I mean, what do you think, Karen? I mean, you're in the business not as long as I am, so you didn't suffer through that last downturn all that long. So you're experiencing good times from the start of your career. But I mean, what do you think? How long do you think this thing's going to keep going?
Personally, and again, I'm not an expert, I think it's going to be at least for another year or so. The other thing that we should mention is one of the reasons that we're not seeing the lower homes being sold is because the banks that do have foreclosures are releasing them at much higher prices.
Right.
And actually, in Upper Greenwood Lake, the banks are fixing up houses.
Yeah. Yeah.
They're selling them at full price after renovating it themselves. So apparently they're also in the flipping business.
Yeah. Well, that's a great comment to add here, because I was going to mention that and I forgot. I didn't write myself a note. Um, the banks pulled a fast one on us, I think, which was interesting, which I believe has been a big positive, and I think they were absolutely smart to do it, because everyone for a long time was talking about, when in the dark days, over the last decade when it was really bad, oh, there's all this shadow inventory, and there's all this inventory that the banks are holding, and they're gonna release it, and it's gonna flood the market with inventory, and it's gonna drop prices down. That was the discussion 5, 6 years ago. And what no one really considered was that the banks actually had some smart people that they were consulting with or themselves, and said to themselves, well, why don't we just hold on to our inventory and rent it, or why don't we fix it up and sell it? So they got smart and they got involved, and, that's exactly what's happened. And I think that really has been a big positive, instead of just, dumping the inventory on the market, not fixed up and terrible shape. They've gotten smart, and we're seeing them do things that we haven't seen them ever do, you know? So that's a good point. Very good point. All right, so let's transition into the mortgage market. Kevin and Joe, we're going to let you guys kind of take it from here. Where are we with mortgages? I mean, we're certainly in an increasing rate environment. I don't think there's any question about that. The Fed has signaled to us that they're going to continue to increase the overnight lending rates into the foreseeable future. So, where are we at? Kevin, let's let you have the first stab, and then we'll bring Joe in.
Well, I think, as far as rates are concerned, for the foreseeable future, we're obviously going to be in a position where rates are trending higher. The media obviously is not doing us any favors with that, although I think, from our desk, it's a positive thing from both sides, the mortgage side and being a realtor, because it's proactive now, in the sense that people are actually taking it serious. And I think we're seeing buyers come out and sellers alike that are catching news of home prices rising. So interest rates today, I think, are driving us a little bit from a productivity level. As far as why they're moving and the future, Joe is really the expert there. So I'm going to pass the mic to him for really what is moving rates and what the future holds there.
Yeah, I'd be happy to tag team, Kevin. Thank you. And thank you again, folks, for having me. I appreciate it. So, I have the luxury of not being caught in the day-to-day whirlwind of mortgage sales and real estate sales. And I spend most of my time on macroeconomic analysis and strategy for the firm. So I'm going to touch bases as briefly as I can on the hot topics, but rather than just opining on them, I want to give some specifics around them and timings for them. And those would be interest rates, inventory, and I'll even touch bases on recessions a little bit. Let me start first with interest rates. So we will most likely be range bound as relative from a 10-year Treasury perspective, from around 275 to 305 in yield in the 10-year. I can talk about that a little bit, but what I will mention is for rates, what that means is we're going to be relatively stable. Should I be incorrect, and that's my base case scenario, should I be incorrect, my belief is still firmly rooted in the fact that even slightly higher interest rates will not meaningfully hurt the housing market. Clearly, at some point, rates rising will have a deleterious effect on a purchaser's ability to afford a home, but we're not at that point now, and we're probably wouldn't be at that point 50 basis points from now.
Mm-hmm.
I agree, Jeff, the Fed is certainly likely to go at least 2 times this year, but what I look at to gauge where rates are going to be, really 3 things, and I'll add a 4th one in there. The first thing is a little known market called the TIPS market, Treasury Inflation Protected Securities. And basically what that gives you a sense of not just what U.S. traders, but what global economists and traders think of inflation. As you know, inflation and economic growth are the 2 primary components of interest rates. Mm-hmm. Inflation has remained stubbornly low. Inflation will most likely remain stubbornly low. Certainly on the wage side. Now you could point to some pockets of the market, which I will in a moment, that are heating up. But from an overall interest rate perspective, that's one reason why rates should remain relatively low. People are forever talking about the Fed increasing rates, and surely the Fed's increasing rates. But you have to remember, the Fed is increasing the short end of the curve.
Right.
It's my belief and my firm belief that as the Fed continues to hike, we will see further flattening of the yield curve. By flattening of the yield curve, I mean that 10 and 30-year rates will start to look very much like 2 and 5-year rates. Mm-hmm. Most of the duration of a mortgage-backed security is in the 7, 10, and 30-year part of the curve. So the Fed can increase rates. And in my opinion, the more the Fed increase rates, the more likely we are to be pricing in a recession, and the more likely we are to have lower, longer-term rates remain where they are or go lower. Now, where that hurts the mortgage market is your ARMs are going to start increasing because they are much more sensitive to the short end of the curve. But 30-year fixed-rate mortgage is likely to stay in that range that I mentioned before because of that as well. The other 2 factors I'll mention very briefly is we live in a globally connected network. There's no way to escape that, and nor would we want to escape that. And why I bring that up is because you have to look at the yield spread between let's look at the U.S. Treasury bond, the 10-year Treasury, currently at about 286 right now, and look at other countries that look like the United States but are not. Let's take Germany, for example. Germany is sort of the gem of the EU. It's an economic powerhouse. Its 10-year Treasury is about 30 basis points. So now you have to look at the process of where real money, and by real money I don't mean necessarily hedge funds, I mean central banks, very large institutions, where are they going to put their money in German bunds or Japanese bonds or Australian bonds or Canadian, all of which are yielding significantly lower than U.S. Treasury, or are they going to put their money in the absolute safest,
right,
securest financial instrument there is, and that's the U.S. government. So again, if you can buy U.S. Treasury for 2.86%, even currency adjusted, or you can buy a German bond at 31 basis points, where's your money going to go? That's why the Saudis are there. That's why the Japanese are there. Even the Chinese, despite what you might hear, are huge investors in U.S. debt for that very same reason. So the only curveball I will add on to that, though, are tariffs. Trade wars are inherently bad for economies. And I only mention that simply because that is sort of the curveball we're dealing with now. My expectation is that sort of the saber rattling coming out of both Washington and China will be alleviated, but it will be a long path. And that's sort of, so in a nutshell, I'll tell you that from an interest rate environment and an economic environment, we are in what I like to call, or what others have called, and I've sort of dubbed because I love the name of it, sort of like a Goldilocks type economy.
Yeah, I saw that the other day, that term.
Yeah, it's not too hot, not too cold, just right in some ways. It's not too hot in the sense that The U.S. economy is growing. It's growing enough to create jobs. And you'll hear me say this multiple times over my career. Jobs are far more important to homes and home purchase than interest rates. I'll repeat that. Jobs are far more important to people purchasing homes than interest rates are. You look at the early 80s. In the early 1980s, if somebody's been around long enough and you say, what sticks out to you about the early 80s, 83, 84, 85 in terms of housing, and they'll say interest rates were 15%, right? But what people forget is that homes were flying off the market at that point, even at 15% interest. And obviously they were flying off the market because when interest rates go up, home prices tend to go down, and people realize they're probably getting a bargain. But there's always a buyer, especially when there's value to be had. So that's sort of the interest rate cycle, and that's why I believe we're relatively range bound. And that's why I believe that even as the Fed goes on in their tightening campaign, we're not likely to see higher rates, and there is some possibility of them driving the U.S. into recession. Now, I'm not a huge believer. I am a believer. I'm a believer in the fact that if the Fed goes too far, they will drive the economy into a recession. Now, the level of recession and the severity of it is one thing, but with the exception of one period of time, the Fed has never begun and ended an interest rate increase campaign without causing a recession. That data goes back to 1950. So the history is pretty clear. The federal manipulating the federal funds rate is like performing surgery with an axe rather than a scalpel. It's a blunt instrument. It's not designed to fine tune, but since they don't have any other instruments, that's what they do, and it causes unintended consequences. Right. So let me bounce over to what that means for housing. It's my firm belief that we are in the last stages. I'll say probably the 6th or 7th inning of a 9-inning game in terms of inventory and credit and things of that nature. So to put that into actual terms, I agree with that we are in about a 12, maybe to 18 months left of this cycle. And you'd ask the question, what is that cycle? Well, let's start with inventory. Inventory, again, has been all of the talk, but people don't really understand why. Why is inventory an issue? Inventory is an issue for 3 primary reasons. The first reason is labor. If you look at the balance sheet of any significant builder, you will note that they have gobs of land, unused land on their balance sheets. So are they holding it because they want to hold it? No. They're holding it simply because there has the Great Recession of 2007 to 2010, and my belief is that it extended even further than that. That recession, we lost about 70 to 75% of the productive capacity of the home building industry in terms of labor during that period. What I mean by that is people who are carpenters, bricklayers, sheetrockers, foundation, those people left the industry, about 70 or 75% of them, and had gotten other jobs. A lot of small businesses, people think that they look at, Hovnanian or Pulte, and they think, oh, that's where most homes are built. A large proportion of homes are built by private individuals, and they left the industry, and it's very hard to get those people back. Sure, you can train people to put sheetrock in, but it's a lot more difficult in terms of plumbers, electricians, and all the other folks who wound up leaving the industry. The other part of the labor issue that we're feeling on the inventory side is some of the large storms we've had, either in Houston or Florida, because these folks can get a tremendous increase in their pay, they've become mobilized. In Houston, for example, a huge proportion of the home builder population, actual laborers, picked up and moved to Houston, and they were there for 6 or 9 months, or maybe some are still there, and they were able to double their pay in a short period of time, and it works out very well for them. So that has an effect across the nation. There's just not enough people to build all the homes that are necessary. But that is quickly alleviating itself. As you can imagine, if you leave corporate America to itself, it will find ways to get and train and get things built. The other 2 things I'll talk about very quickly are municipal fees and laws. if anyone has ever tried to go to their town hall with design plans to build a house, you know exactly what I'm talking about. Between fees and setbacks and all the different rules that each individual municipality has, it's a cumbersome project. I don't know that will be cured in the next 12 to 18 months, but it's been my sense and sense of some of the folks I've spoken to directly, even at the agencies, that municipalities, in order to help increase their taxable base, have become a lot easier to deal with. And then we get back to tariffs, and this last part is not necessarily a good thing, but you know we're also in a war of words with Canada. We get a disproportionate amount of our home building lumber from Canada. Tariffs have already begun to affect the price, and don't forget, Wall Street is a forward-looking mechanism. So even the expectations of potential tariffs increase the price of lumber futures. So that is probably the one offset to that. And without taking up too much of your time, I'll talk about credit easing. There's no question in my mind that we will see continued credit easing in the next 12 months, I believe. Now, how the form in which that takes is not as certain as the fact that it is coming, but I will tell you some options. It would not surprise me at all to see MI on the FHA side reduced, if certainly for first-time home buyers. On the purchase world, I think that would be very beneficial. It would not surprise me at all if Freddie Mac followed Fannie's lead in terms of easing and DTI and LTV restrictions. It's very interesting to me that the average renter spends, these are national statistics, spends 50 to 55% on their rent, and yet for the most part, we're capped in the low 40s in terms of DTI for purchases. So we're likely to see that change as well. And then the last thing I'll talk about, which is significant, is the sheer tailwind of demand is not going to cease. So you look at the aging of the millennials. So I'll ask this question. It'll be a rhetorical question. You know, by 2025, there will be about 10 million new household formations. About 35% of that are coming from millennials. Another 35 to 40% are coming from the Hispanic community, understanding that there's some overlap amongst the two. And about 10% are coming from the African American community. So we're talking about 70 to 80% of the new housing starts and new homes looking to be purchased. Again, this is a forecast. Looking to be purchased are coming from folks who need the services of groups like ours. They are in some ways DTI challenged. In many ways, they are first-time home buyers. And they're going to need the assistance of a qualified real estate expert, and they're certainly going to need the assistance of a mortgage expert. But it also lends to the credit easing argument I was making earlier, that if you want people to increase home ownership, which is at a historically low level, and I would tell you that there's even something a bit Machiavellian about it, in that if you want to juice the U.S. economy, sure, tax cuts are great, but they tend to favor the wealthy. What you do is you spur home ownership. Home ownership lends itself not just to building communities, but it also lends to everything from Home Depot to furniture stores to what a segment of the economy we call durable goods, things that last 12 months and more. And there are a lot of smart folks in Washington, certainly on the economic side. They understand this, and it's a great way to pull the economy out. So, you know, what we believe is that in the interim, so 12 to 18 months, we're going to be range bound. Inventory is still going to be an issue, but less of an issue month by month by month. I do believe that institutional investors, I know Jeffrey mentioned it, I mentioned it, they do hold a huge amount of properties. It was a brilliant trade by them. But like all trades, you have to have an exit strategy. When home prices are this elevated, the yield that they'll be able to get on the final disposition of these homes will cause them to start selling. It's foolish for them not to start selling. You're already seeing some of it. I don't know what percentage has been sold, but as a guess, I would say maybe they're on the 10 to 15% side, so they still have a lot of inventory left. They're not going to dump it onto the market, but you can bet if homes are selling above asking, or at least at asking, and you have to remember, a lot of these folks picked up properties, say in the Las Vegas area, for 30 cents on the dollar.
Right.
In some sections of California, 30 to 50 cents on the dollar. Even in the less hard-hit areas of New Jersey, they're still getting deals at 60 to 75 cents on the dollar. So they're going to be able to get their 25% return on it plus, and it's been kicking off a coupon for the last 2 to 5 years. So it's been a very, very profitable trade for them. It will begin to unwind it. And in the interim, so what do? You stay focused on educating the consumer in our world, letting them know that low interest rates, that home prices are going to continue to increase. It might be wise for them to get in now. We have a renovation product. I don't know, Keren, what we'll be talking about, but that's been an overlooked area for many people, because some of the homes that are available, or many homes that are available, need a little bit of work, and there's some real benefits to that. And you play the long game. You know, by this time next year, it's my belief that we will be in a very different market in terms of inventory adjustments, a more normal market. But it will take, again, in my estimation, a full 12 to 18 months until we're back to a place where there is a healthier balance between demand and supply. Probably more information than you wanted. My apologies for being so long-winded, but
No, it was good.
I hope I was able to provide some useful tips.
No, and we're going to let Kevin talk quickly and briefly about renovation loans, but just one thing that I wanted to point out, and something that you said I've been thinking a lot about lately is, and I don't know Census Bureau data well enough to really understand population, but, you know, it's just a funny thing to me how hot both the purchase and rental market is at the same time. And to me, it just shows like there's a true housing shortage. You know, there's just literally not enough places for people to live. And I think, you know, I've heard some stats about the size of the millennial population being larger than the baby boomers. And again, I don't know Census Bureau data well enough, but to me, that may be the single biggest reason why this thing does sustain for a longer period of time than we may be willing to admit. You know, I mean, we're thinking about historical perspectives and what's happened in the past. And of course, that's always a pretty good indicator of what's going to happen in the future. But, you know, it's just interesting to me. I just think we have a massive population that's just trying to get into homes. You know, it's aging.
Yeah, and think about it. I'll answer this quickly by saying you're 100% right. And when there is pent-up demand or limited supply, the cycle is elongated.
Right.
So if there were plenty of supply and there was this level of demand, you would see a much quicker run-up in home prices, and you would see a much quicker cycle, simply because demand would be filled. So this cycle will be elongated and stretched out, which is why I'm a firm believer. If you're going to be in the housing market and you're a true player, and what I mean by that is you are focused on purchases, you are focused on providing more, on getting the right people into the right home, there's plenty of business to be had, but you do need to exercise a little bit of patience during the next 12 months.
Sure. Okay, good. So Kevin, let's talk quick about renovation loans. I mean, I know that you're really an expert on this, and I believe that this is a very important piece of the puzzle, because I know that there are a lot of homes out there. I mean, you know, we talk about how hot the market is, but yet there are homes right now on the market that just won't sell because they're not in good shape. So
yeah, well, I'm an expert by accident, for the record. And the only reason why is because I used to use this as a conversation piece to come talk to guys like you and try to get you to give me other business.
Right.
And, you know, so oddly enough, it became a very tangible program that just started to become very valuable, both in production for us and obviously being able to provide value to the market, to folks like you, and obviously home buyers. And you know, the market, I would just say, just to generalize renovation lending, it's very underutilized, but it's probably more underutilized just because of people don't understand it, and there's a lot of misconceptions out there. So,
sure.
You know, if you right now, just to be brief on how these things work, there's really two different types of loan programs for renovation lending. There's a conventional loan program, there's an FHA. The reason why that's important to mention is because that opens up the versatility of it as to who it can serve for a buyer. Really, down payments are as little as 3.5%, which is fantastic, to be able to buy a home and get the renovation funds needed to actually buy a house in a lesser than quality, condition for a regular conventional loan would allow, on an appraisal or, be able to close on. And it also allows for lower credit scores, so like Joe was talking about, this credit ease that's happening, these loan programs, with renovation and a lender closing on a loan on a home that's in less than par condition is pretty nice. It's very flexible in that sense. But I will say that, the flexibility also doesn't stop there, because you can utilize these programs now for a primary residence, a second home, and an investment property. So, that opens up the range of the available buyers that can use these programs. The loan, in a sense, will allow for somebody to buy a house, have a qualified contractor that we would approve, bid on the work that needs to get done. In some cases, depending on the size of the work, there's a HUD consultant that comes in and does what's called a specification of repair report, which tells everyone involved what's the feasible and required repairs that need to get done. And there's some security features there, because they'll say this is how much it should cost, so that when you get a contractor estimate on it, if you see a disparity on what the HUD consultant saying something should cost versus what a contractor is bidding on the work, it just raises a red flag for everyone to say, okay, let's just make sure we're on the same page and we're not getting beat over the head with a bad quote for this work. But long and short of that, the process allows for, again, the renovation funds to be bid on by a contractor that we would approve. And for you to close on the house, the money goes into an escrow account. The contractor begins the work. Typically, they have up to 6 months to complete the work that needs to get done. We pay the contractor after the loan closes. And, the borrower and buyer does not have to worry about handling the accounting, does not have to worry about handling the funds. They're not getting a line of credit and running to Home Depot. They cannot actually handle the money. They can't do the work themselves. So it's a very streamlined, organized process. And I think that's where, a lot of realtors too, for example, they think that they don't, there's a loan for the mortgage, there's a loan for the work. They don't get paid until it's done. I mean, these transactions happen just as fast as normal, regular transactions. 45 to 60 days is the most common area. And, they don't just help buyers. You talked slightly a little bit before about this lower range of home prices are not moving. Typically, that's because the condition of those homes are not well, and right. They might be bank owned, and they have listings that say clearly in them, right? Most you see it more often than not now, cash or renovation loan only. Yep. Well, I'm a sales guy for 15 years. People don't sell things they don't understand. So this type of program are really coming out hard into the market with education. We've thrown some larger seminars this year. Jeff, you came to one earlier in the year, but I think education and having buyers and real estate agents alike understand it is really what's going to kind of put some wheels on this. And that's really one of our big motives right now, is to really just bring that out into the market and show people how easy these products are. And I mean, the before and afters, and the ability to take buyers who don't have the affordable range to be in the the $200,000 to $400,000 price range can now buy a home that's priced under market but is not in a condition that it needs to be in, can use a renovation loan to now be in a price range that they can afford, but also get a house at the end of the day that they would feel happy to live in, by using the renovation. And there are a large segment of banks that don't want to do what you were saying before, fix a home and sell it. They just want to sell it as is. They're not in the business to own real estate, and this is the perfect program for that. So yes, and general. I mean, I don't know if you have any questions just about it, but that's just some basic stuff.
Well,
Jeff, can I interject?
Yeah, go ahead, Keren. Go ahead.
I was just going to say that I actually very often am able to sell a house saying that there is a 2 or 3K loan, and a lot of buyers don't know anything about it. And the fact that I do, and the fact that I can explain it to them, just opens up their vision to so much more, because they look at a house, they see the rugs, they see the walls, the punched out doors, they see all these things, and the first thing I say is, hey, by the way, have you heard of a 2 or 3K loan? And they say no, and I said it's a renovation. Then I go into the details, but the fact that I know how to explain it and to broaden their horizon as far as how they can purchase a house that is not in mint condition really does open the doors for more transactions than not for those buyers that don't qualify for the $300,000-$400,000 loans.
Absolutely, yeah. Just for the record, we do have some certifications that we do at AnnieMac to help real estate agents. We have a professional delegation for that, so we can pass it along to Jeff. Just interestingly enough, one area on the listing side of things, these products don't only benefit the buyer. I'll give you two examples. One, we've successfully taken folks that wanted to sell their home, that were borderline upside down, but very close. Let's just say they have a 2-bedroom ranch with 1 bathroom, and they owe $200,000 on the house, and it might be worth $205,000. The transaction would leave them owing money. They don't have the money to close at that point, so they're really kind of stuck in being able to sell. We've successfully had a lot of scenarios like that where we've added a level, we've added bathrooms and bedrooms, and obviously created a home that can now be compared to other homes and increase the value of the house, leaving it in a much better sellable condition where in many cases, these folks were able to sell and also leave the closing table with profit, with proceeds that they could then take and buy with. So very, very good tool to utilize there. And lastly, from a seller's position, homes that, might have a failed septic tank and they don't have the position they're not in a monetary position to put that in themselves, but they might have some equity. That's a perfect example of marketing a home with a renovation product to have the buyer be able to take on putting the septic tank in themselves, and the seller can just sell the house to them at a lower price where they can pick up the cost of doing so. There's a lot of examples like that, but sellers certainly can benefit, and real estate agents alike, where it's more of a marketing and ploy and some vision that you can put out there to buyers to help sell more houses. So it's definitely.
If I could add one more quick thing, I would say that you have to buyers need to understand that certainly people want homes because they want to raise families. That's ultimately the reason why. But if you're looking to build wealth along with your home, in many instances you are building instant equity that the buyer just needs to see that, and they don't always because they're undereducated.
Yeah, absolutely.
No doubt about it. One final point I want to make on the renovation loan, and I'll give you a couple clear examples. First of all, just knowing about a 203K loan and knowing that they exist is not enough. They are very tricky loans for the loan processor, the originator, to do. And you really need to get a mortgage banker that knows what they're doing with these loans, because there's a great divide, okay? And there's probably not a mortgage banker out there that's going to say, no, I don't do that. But let me give you an example. My son just tore his ACL in his knee. And when we were, researching the right surgeon for him, one of the key questions that I was asking the surgeons was, how many of these do you do a year, right? And I wanted to go with the guy that does like 200 a year, not the guy that does 20 a year. Kevin and Landy, these guys down at AnnieMac, they do hundreds of these loans a year, and they're very good at it, and they have staff built to support it and process it, and because there's a lot of minutia that has to get done in order to get these loans processed. So, these guys are really good at renovation loans. They're good at all loans. They're not just, I'm not pigeonholing them just to renovation loans, but they are exceptionally good at these. So if you're a realtor, no matter if it's Green Team or whoever, these guys are solid. So
thank you, Jeff.
And I'm sure there are others out there, but it is important that all of us in this community are aware of this, because we need to move this market. We need to keep it going, and we need to get all those homes that are diamonds in the rough, get them turned into diamonds and get people in there. All right. So thank you, everybody. I just wanted to wrap up with this one last slide here, which is how we can all stay in touch and stay connected. Our next housing market update is going to be August 14th. It's a Tuesday, 2018 at 9 a.m. We always do the second Tuesday of the month at 9 a.m. And Melissa, our marketing director, has created a page on our website, greenteamhq.com/HMU, that will help you stay connected with everything that pertains to the housing market update. We do a follow-up blog post. We send out emails. You can get on email to get updated as to when the next one's happening, with registration links for the webinar so that you can be part of the webinar, so on and so forth. All right, so thanks everybody for coming today. Joe, Kevin, Melissa, Karen, I'm greatly appreciative of your time. I hope that you'll come and join us again. Maybe in a few months we can do this again and see what our predictions held and see how we did. All right, everybody, take care.
Thank you, guys. Have a great one. Take care.
Take care.
Bye-bye.